Berna, you're in New York, right?
I'm in New York, freezing my ass off.
That's what I asked.
It's
You
nice
know,
here in Los Angeles.
Yeah,
I,
other
I
than
left.
other than being partially on fire, yes.
Well, where
I
I
left
am
New.
in Hollywood, it's nice.
Yeah.
West Hollywood, I should say. Actually, I'm in Beverly Hills right now in my office, but living over there. It's not that big a deal over there, but yeah. It's not really. I think that fire's mostly done now, isn't it?
There's I think it's like 50% contained last I checked. I mean, there was a new one that started, but like north of the city. 72% contained now.
Yeah, there you go. That's contained.
Um, yeah. And let's see, the other one is
Well, we're going to have new fireworks when Trump visits.
Oh boy. Oh boy. Oh boy.
Oh yeah, the new thing is 14%, but that's like far from, of course, on the ever so handy Watch Duty app. But it was but that's like northeast of the city, the new one. Hearing about a lot of people moving already, which is interesting.
Well,
I know
there's
Charlie should be
there's
talking about
move.
housing. So. What?
Yeah, I mean, there's nowhere to move. Like, if you lost your house, there's nowhere to go.
I know there's so few apartments for rent and stuff.
I mean, not like apartment. Like, there's a lot of apartments that are 1 or 2 bedrooms, but there's not like a lot of loose bungalows and whatever. I mean, LA is stupid. They should build up. This should be their moment to say, hey, let's build a bunch of new high rises, really nice ones.
Mm-hmm. I mean, they have that in Century City and
part of Beverly Hills has it.
Beverly Hills, yeah. There's not, like kind of mid city. There's some nice high rises, but sort of probably near where your office is. But not too much of that. And then right on Ocean, of course, too. But not very much of that. I've been running around all this morning. I haven't really seen the news of the day. Jobless. Anyone have any thoughts?
Getting destroyed.
What's that?
Electronic Arts is getting destroyed. Down 20% today. Big miss.
Yeah.
Canada came in light on their retail sales. There was a bad report at HK Linux, and that sent all the chip stocks down. We actually shorted ARM yesterday when it was up. Covered it this morning. It's like, I don't know, it was at 180 yesterday. We shorted it. It's now I think 163 or something. That's stupid. Russell's short that also. Although I think he's been shorted for a little while.
Is Russell on?
You ever trade Mercado Libre, Berna?
A long time ago, not recently. I wish I had traded it more recently because I think it's done pretty well. Like in the early days, I owned it. Yeah.
It's been pretty bad for since September.
Yeah,
We're short
very
of it.
short. I was thinking more about since 2022, it quadrupled.
Oh yeah,
bad since September, but 4-bagger since mid 2022. So not bad.
Yep. No, they've done real well. It's all about markets are fractal. It's what's your time horizon.
Right. Yeah, my time horizon tends to be longer. So this.
But it hasn't done anything since 21. To be fair, Jan 21 and the fall of 21, it's same level. So flat stop for 3 years. Good buy in 22 though.
Yeah.
All the tech was a good buy in 22.
Good point. Yeah. It's interesting. You made me look at eBay. Even that's up 50% in the last year.
I mean, everything's pretty full. I mean, multiples are full. The rest of the world,
not in small cap consumer. Let me tell you, they're not so full there.
How about American Eagle?
I'm kind of lukewarm on that, but
Just saying.
cheap is not. This is the words to live by. As a value investor, I will tell you, especially at the mall, but in general, in small mid consumer stock, cheap is not enough. You need cheap plus improving business momentum, or cheap plus some kind of catalyst or turnaround or corporate event or something.
I'm not a big believer in catalysts. I think catalysts are priced. I think that's something people are like, oh, it's a catalyst. Like, things are bad and they're going to do something is the embedded catalyst.
But the reversion to the mean is not a thing, especially in retail. So sometimes when things are bad, they're only going to get worse. So you really need to have some kind of visibility on how it's going to get better, or else it's also a good place to go looking for bankruptcies. Not American Eagle. I'm not saying that, but things can stay cheap for years and years. So anyway, I should get us started on our actual topics. Welcome to Wall Street Beats. I'm Berna Barshay, and today is Thursday, January 23rd. And with me today are Brey and Charlie Peabody. And Ben's going to tell us about a new trade that he has, and Charlie's going to review the housing sector for us. So I'll let Ben kick it off.
All right. Hey, how's it going? Charlie, I like your hat.
Having a bad hair day.
Anheuser ABI InBev, Anheuser-Busch, the former great American beer company. This is like, if you remember last May, I had pitched on this show British Tobacco, and it was $29 and very hated. There was lots of things you could say, too much debt, blah, blah, blah. And that was a great stock. It went from 29 to 38 and paid a bunch of dividends. This kind of reminds me of that. So you're like trough earnings, trough multiple, trough hate for Europe, trough hate for staples. And Jen, you can pull up that relative P chart that I sent you. But I'll keep talking if you don't have it. And so this is a stock that's not, there you go. You see it's at the bottom. And then the price is near the COVID lows. Everybody hates Europe. Everybody hates staples, except for Costco and Walmart, I guess. They hate, there's probably a gigantic long Costco, long Walmart, short everything else trade going on in some of these pods, to be honest. But anyway, so what's discounted? Weak volumes. Gen Z doesn't drink beer, blah, blah, blah. It's a 3.5% dividend yield and a 10% free cash flow yield. These guys have taken debt down from, let's talk about 2019, because, obviously something happened in 2020 that was a changing event, if you will. Debt's gone from 103 billion to 75. They've accelerated their buyback. Top line's gone from 52 billion to almost 60, 59. Yet, EBITDA is flat. Gross margin has contracted quite a bit. And so there's new potential for a margin expansion story. And these guys are, they've accelerated the buyback, so they're kind of serious and they're paying down debt. So you like that. There's also this internal system. They basically have an internal DoorDash. It's called Bees, B-E-S. They do 50 billion of GMV. Now it's their own product. They only do about 5% of other guys' product, but it could grow into that. But no one's ever even heard of it, right? So DoorDash is like 75, 80 billion, and these guys are like almost as big as them. And it's a way that the retailers can just order on demand their product. I would think that over time it's going to help working capital, and it's going to help the multiple as more people realize it. But in general, I like as Berna knows now, I like to buy things when they're hated. And whether it's Chinese stocks or British tobacco, and I look in a market where a lot of stuff is the opposite of hated, this is one of those things where you get a world-class company that has, 200 billion EV or 190 billion EV, but how much can AI help them? All these distributors, not just InBev. Like, I think that's a trade that's not being talked about enough, is what can AI do to improve efficiency and margins and distribution companies? And so I just look at it as like, hey, how much cheaper can it get, and how much more Haiti can get? Probably not much. They're actually up 1.5% since we bought it. So yeah, I'm kind of like kicking the tires more and more, but it checks a lot of boxes as something I want to be looking at and long.
But do you know what their volume growth was in the most recent period? Like, are they still are they positive volume growth?
They were -1%, but
Okay.
it's been, I got it right in front of me. It's like since 2019 again, 1%, -6 in COVID year, obviously, 9.7 in 21, 2.3, -1.7, -1.2, and this coming year they're expected to do 1. So it's
Okay.
not, it's discounted that there's not much in the way of volume growth.
Okay. I'm gonna throw out two things for you to look at, Ben, if you're interested in this area that are sort of on a similar theme. I am not, as I mentioned before, the show started to Ben. I was short for a long time this company, although as Ben I covered around where Ben's buying. So as he pointed out, we were both buyers at this level. I'm not a fan of this management team. I'm also I personally think that this company is in secular decline, not just because Gen Z drinks less beer, but we've been in a quality over quantity environment for alcoholic beverages for a long time, and kind of the middle of the sort of not totally discount, natty light stuff or Pabst Blue Ribbon or generic, but the just above that category, which is where Bud sits, has been pretty much the worst place you could be in beer. As young people have moved to like Mexican beers and craft beers, and that's where the beer consumption is happening. So the entire sector has been shellacked for two reasons. One, just a COVID hangover because people were buying so much booze when they were locked up, and that led to tough comps that haven't been offset by the on-premises, the restaurant and bar drinking. The other thing that happened is the Surgeon General warning about how alcohol is really bad for you, and maybe I think the carcinogen that whacked all the stocks the other day. But I would say two things: like the best beer company that is a standalone beer company to me is Constellation, and that one has just been shellacked as well. Just went, pulling up the chart, it just went from 240 to 175 like a couple months ago, and volume growth is still positive there, and just a better secular story. And I think it's 12 PE to Ambev's 14 PE. So if I was, I personally have been doing a lot in this area, but if I was looking to do something in this area, I would personally be looking at Constellation over ABI. Just one to throw out there. And if you really want to be sort of playing the Europe rotation, Diageo is another one that has just been shellacked. And this is something that I owned during the pandemic. It's basically back to where I bought it in the crash. Like it's, almost at, I guess, like maybe not February, March 2020 levels, but April 2020 levels. It's gone from 220 to 117. Now it has a premium multiple to ABI. It's probably 17 times to ABI's 14 times, but it does have 4% dividend yield and much better assets. It's got Guinness, it's got Johnny Walker, a whole bunch of, Captain Morgan. I can't remember them all off the top of my head. The Rock, which is not worth what it once was, but, a bunch of other good assets in there, and probably better position from a premium. So anyway, I think you're able to.
And also, I think you're just not understanding what I'm talking about with this bees. Like that could be worth 50%, 25 to 50% of the EV. Like that.
No, that's interesting. That definitely is interesting.
Yeah,
I'm not. I don't trust this management team, so that's a problem for me. But
they're paying down debt and they're buying back stock at accelerated rate, just like British Tobacco was. Like,
no, it'll probably work. It'll probably work. I'm just throwing out some other ideas.
Cigarettes are the best stocks, and they've been negative volume growth forever. So like, it's not, that doesn't bother me.
Yeah,
like,
but do you know what the difference between cigarettes and alcohol is? Cigarettes, you're addicted and there's no substitute. So the pricing power, they've basically been able to price their way out of negative volume forever. Whereas in alcohol, like there's more of a gating pricing factor because you can switch from one brand to another or one form to another, beer to alcohol, alcohol to wine, etc. So the dynamics are a little different, but I hear you.
Actually worse. I'd say it's worse than cigarettes because the Chinese vapes took a bunch of share, and now you have all these ZYN. So there is all kinds of alternatives within that. And alcohol is addictive. Like, it's an addictive substance.
Oh, 100% addictive. But like, I'm just saying, like, if you whether you get drunk on beer or drunk on vodka or whatever, like, there's just more of a gating around the pricing. Because
anyway, it's trading at the COVID lows. I like it.
No, I think it works from here. That's
what I'm trying to say. It's like, hey, there's no expectations, and I hear you on Constellation, but these guys have a 4 times, 5 times bigger business. They're the biggest international beverage distributor around the world. There's lots of things you can do. You can drop in things. You can clean house, and then also there's one thing that it's not central to my thesis in any way, but they have all this excess capacity that can be used to create protein that can be put into the food system, like cellular. I don't know if you know about like cellular, like protein creation, but like it's something. And I talked to a scientist who works at Miller about it, and they're testing it out, and that could be just another revenue line. So there's all kinds of things that they can do, and when you're just trading at like trough, you're not paying for anything.
It's interesting you say bigger, because I don't think bigger is always better in consumer, right? Because the trend is towards artisanal and specialized and personalized. And so sometimes being mega, like you're seeing that with Nike and with Starbucks, and, sometimes like getting too big can be a headwind to growth. So that's all.
Maybe, and also just one other thing is, remember, they took it in the chin with that whole woke thing that they did 2 years ago, right? So they got pulled out of Costco at one point with Bud Light, and so
that set up some easier comps.
Yeah, just a lot of missteps that I think that happened, and this is how you get, like, you could tell me everything that's wrong with it, and like, just like you told me everything was wrong with China, and then it ripped. Like, it's always easy to like point out what's wrong at the trough.
Right. I'm just here for a counterpoint. I got no skin in this game.
Oh no, I know. I'm just, not you, the collective you. Like whenever you buy stuff like this, it's like very easy that people tell you everything that's wrong with it. You know what I mean? Like, oh, what about this? What about this? Like, price like that. It's like an international. It's very hard to build a distribution business. Would you agree? Like, and so I don't think of like these things as brands as much as I do as like distribution businesses. And this is a world-class distribution business. That's the way I think about it. It's a collection of brands. I mean, they have a lot of different brands, and they can buy somebody else if they get as long as they're paying down debt and buying back stock. And
how are they? I mean, they're still pretty levered. I mean, they're
probably, they were 5.5 times, so now they're 3.5 times, going to 3. So yeah. But, as a shareholder, you want to see that. That's you're taking a larger percentage of the EV. It's like the LBO model. So
right.
You can have a flat business, but if you're paying down $7-8 billion of debt a year, that's a 10% accretion to the shareholders, right? So you get 3% dividend, 8% from debt, and maybe another couple percentage in buybacks, and you're getting like a low teens type of accretion. But the multiple contraction and margin contraction has just offset that. But if there is any kind of change in sentiment, you'll realize it, and you realize it in a very short period of time.
Right. It works both ways, right?
And it has worked for the downside. That's what I'm saying.
Right. Like, when I was short this, the debt was a problem and not a feature. right? Like it can be a feature or a benefit depending on where it can be a benefit or a problem depending on where you are in the cycle, right?
Absolutely, and I guess all I'm trying to say is that like it's definitely feeling very troughish, and their debt is at 78 billion, and it was at pre-COVID 103. So that's 25 billion, and the enterprise value. I don't think so the enterprise value is down 90. Okay, so you've had $90 billion of enterprise value erosion, and so the percentage of the company that the stockholders own is now it's about 60% out of the EV. So I don't know. I'm just saying that like you keep bringing that down, and as long as you don't get into some kind of negative 5% type of volume growth world, negative 1% volumes is not an issue in my opinion.
Yeah, -1, no. It starts to be a problem if they get over -3, 4. That's where the market gets nervous about it. Well, anyway,
that would be, right. If you get that kind of thing with that debt load, it becomes a real problem. I agree with that.
I agree with you that this trade is probably going to work. I probably the whole sector is probably interesting from, there's just been such negative sentiment. Probably worth getting to these other names as well. Diago's been on my lookout list for a while for a lot of the same reasons that you've talked about here. So
yeah, I just think it's like super out of favor, and you could just get like, hey, let's just say we go in a recession, right? Like in a recessionary environment, these businesses are relatively more interesting, and right now we're not. We're in like buy Bitcoin, buy AI, whatever. But if we were to go in a recession, I feel pretty good about like their business.
Yeah.
I don't think it's like
the central risk off stock place to hide for sure.
Yeah, and it's hard to do that in Costco here with the multiples where they're at, right? Like it's not like. But
good balance to your Joby, right?
Yeah, very different. Barbell.
It's the anti-Joby. So that's the drone company that Ben's talked about in the past. In case anyone doesn't know what I'm talking about. Anyway, I'm gonna move on to Charlie. Information. I think that we've had some reports out of the home builders, some news. What do you got?
Well, let me just pick up where Ben left off, and if there is a reason that we might go into a recession, it would be due to a significant correction in the housing market. So I wanted to talk about the housing market. Earlier this week on Tuesday, D.R. Horton reported earnings, and it was a beat of lowered expectations, and gross margins were maintained, and so that was constructive. Tomorrow we get existing new home sales. I don't know, Jen, if you have that chart ready, but the pending home sales index that came out earlier, which sort of anticipates what new home sales or existing home sales will be, suggests that we should get a positive report tomorrow, above the November number of 4.1 million units. And then on Monday, we get new home sales, and that should be positive as well. So we're getting some constructive news coming into a situation where a lot of these home builder stocks have corrected quite significantly. So I wouldn't rule out some kind of a bounce, but I'm not going to buy that bounce. I still think home builders are short longer term, and I think the housing market is still a problematic product. So we'll see. I mean, the proof will be this spring, because right now, if you look at forecasts from Wall Street, they're talking about housing sales being up, mid-single digits, 5% plus or minus. The Mortgage Bankers Association is talking about, purchase mortgage applications rising 8% this year. So there's a lot of, anticipatory constructive news out right now that could, cause a little bit of a bounce in these home builders. I'm not going to play that bounce. If anything, I would short more. If let's say D.R. Horton, which reported on Tuesday, gets back up to above 160, I would short it there. So here are my reasons as to why I'm still staying negative. Jen, if you can pull up the first chart that shows units under construction. This peaked in early 24 and has been rolling over. This is the future lifeblood of home builders is, what they have under construction that can come to sale. And if you go back to D.R. Horton on Tuesday, they did say that their starts were down 10% year over year. And the reason that you're seeing, this type of drop off in starts and construction is because of the new home inventory supply. So, Jen, if you could bring up that chart. So this shows new home inventory supply. It's about 490,000 units of inventory, which represents about 8.9 months. This is the highest level of new home inventory since the 06, 07 peak in new homes prior to the crash of 08, 09 in housing. So it does imply that even with the kind of incentives that were being offered today, and by the way, incentives from new home builders are at 2-year highs, and spec, the spec inventory is at 2-year highs. So we're seeing the kind of things that one would think would lead to a drawdown in inventory, and yet we're not getting it. So I think that we're going to see, people like D.R. Horton who are projecting, growth in sales disappoint this year, or they're going to have to give up on the gross margin, which they're claiming that it's going to be, stable this year versus last year. So let's go to the next, slide. This shows mortgage purchase application index. It's at a 30-year low. You have to go back to the 90s to find this type of lull in mortgage applications. And so this is obviously a combination of a decades high mortgage rates and soaring home prices that have left many home buyers on the sidelines because affordability is a big problem. And with financing costs rising, mortgage rates now are above 7%. I just don't see a solution to the affordability problem unless we have a significant correction in housing. So let's go to the next slide. This does show that the affordability index, again, at the lows that we haven't seen since 06, 07, prior to the crash of housing in 08, 09. So this is where we were at the last housing bubble peak, and so I think we've got a problem here. And then the last one that I want to show is the median mortgage payment versus the median monthly income. And again, the median mortgage payment is eating up about 30%, a little over 30% of the monthly mortgage payment. The monthly mortgage payment is eating up about 30% of your income. So we're now above that peak that we had in 06, 07. And it says affordability continues to be a major problem for the consumer. So the only way I see this being corrected, other than some sort of, there are 3 ways. Obviously, you can have lower rates, which I think is going to be very difficult given my biases about where inflation is headed. You could have you could have government subsidies, which is something that is being talked about and worked on, or you can have lower home prices. And I think the latter is how this thing is going to play out. So if you look at the existing home affordability index, it's about 25% above trend, which would suggest that's the type of correction in home prices you could be facing. If you look at the new home affordability index, it's about 10 to 15% above trend, which says that's about the type of price correction you'd have to have for home builders to get back on track. So I think we're going to see a very significant correction in home prices, and that's going to weigh on consumer confidence. And if you couple that, to go full circle as to where I started this conversation, if you couple that with any sort of stock correction, those are the 2 big assets that consumers own. And if you have a housing correction and a stock correction at the same time, I think those 2 things push us into a recession at some point in 25, 26. So I'll
Can I
leave
ask
it
you a
there.
question about housing prices? So, we saw mortgage rates go from, maybe 3% in 2020 to nearly 7% now.
Mhm.
Normally, in the 25 years that I've been watching this, like when rates move, prices go down, and there's that reaction. Why has that not happened, more
Well,
dramatically, especially given the fact that there are, high inventory levels out there?
it's well, first of all, it didn't happen in 23, 24 because you still had the stimulus money running around the system. Um, so that was a big piece of it. But you are starting to see pockets of weakness, particularly in Florida and Texas right now. And I think that's going to spread around the country. There is optimism, that the fires in LA will help the home builders out. I'm not sure I agree with that, but there is optimism there. Um, so, why haven't home prices dropped more dramatically is, I guess, your question. And I think this is just a process of time. I mean, this is a slow moving asset when it gets repriced.
Hmm.
But I
So,
think you're
are you
starting.
saying Florida and Texas are the new California and Nevada? Are they our canaries in the coal mine? Just kind of.
I, yeah, I think that's a good way of putting it, Berna. They are the canaries.
Um, so, do you think that this time? I mean, because in 08, 09, we saw, pretty big dispersion, and this is less of a home builder question, but I think everybody worries about what their house is going to be worth, right? Do you think that there'll be big dispersion? Because, you were seeing, in markets like Las Vegas, over 50% drops in '09. I mean, I remember driving through in '09 and seeing apartments being advertised for $200 a month rent. It was crazy. Whereas, where in New York City, apartments dropped maybe like 10, 12%. There was, because constrained asset, we didn't get to overbuild here. Do you think that it is going to be very localized again this time with maybe the Sun Belt, as ground zero for this kind of price contraction and the drag that comes with it? Or do you see it, sort of spreading to all regions?
Yeah, the bottom line is I think it will be much more localized this time. Was it Ben? I don't know if you remember. Was it Ben Bernanke that said that what happens in Portland, Oregon, won't happen in Portland, Maine? In other words, prior to the '08 housing bust, no one thought it could be a nationwide phenomenon. That it would be more of a localized phenomenon.
I
And I
would
do
say
think
I would
that.
just to push back on that a little bit though. There's different dynamics at present of funding versus then. I think if you look, there was just so much ARM funding, and and that's why it was easy for us. I was a young grad student, and it was very easy to see like this is coming. Like you look at when all the resets come, and I think that the issue now that's causing it is like you see Trump sending guys back to work. Some of the banks are sending. There's a lot of people who moved who now have to go back to work, and that's going to bring some housing on or some supply on. But like the people who are like sitting on the 3.5, 4 just aren't moving, and they're sitting at prices. Like I know people who are trying to sell their house. They're sitting at prices that are won't clear, and that's why you get the mortgage application thing you have there. So it's just what unclenches this dynamic. Is the only issue. Because I think everybody's saying what Charlie's saying, but at the same time, somehow you have Austin's down 30%, Palm Springs got drilled, whereas like Buffalo and Michigan are doing really well. Milwaukee's doing well. So there is some weirder dynamics that go on now that aren't quite as national as they were then because of the funding, I think.
Yeah, the other thing, Berna, that going back to your question about parallels between today and '08, the banking system today has been much more conservative in their underwriting of residential real estate. And so I don't think the banking system will be impaired if we have a 25% correction in existing homes. There'll be some, defaults and repossessions, et cetera, but not of the magnitude we saw in '08, '09. I think the real issue is what does the collapse of home prices and potentially stock prices due in terms of the negative wealth effect on consumer
Sure.
confidence. And that's really what I'm focused on.
Yeah, I mean, I think the other thing that you don't have this time, which you correct me if I'm wrong, Charlie, because I'm sure you know, is you don't have the HELOC game happening. Like, there was there were some very specific disruptions because people were using their paper profits on their house to fuel, just profligate spending, and that was part of what happened last time. But I think they've been tighter on those that kind of credit extension. Is that correct?
That is correct. And we've seen very little growth in HELOCs, very little. We haven't actually seen much growth in residential first mortgages either. So if there is if there is growth, it's outside of the banking system in the monolines. And while some of the things like Rocket Mortgage and Zillow and Compass, those are all being touted by Wall Street. I think if I'm right about the disappointment in the mortgage purchase market, I think those stocks are going to succumb as well, finally. But yeah, they're being touted because they have the new technology and origination capability and sex appeal that the traditional banking system doesn't have. So we'll see what happens there. But those are not names I would want to own longer term.
Yep. Well, something to watch. Those are some pretty compelling charts that you threw up there. So, I think that's going to end it for today. I want to thank everyone for joining. Remind you to come check us out at wallstreetbeats.com. Like if you want to get a look at those charts that were up briefly, the written research that we have up there, our chat where we're commenting on the markets in real time. You can find it all there. So thanks for joining. We'll be back tomorrow with more ideas. Have a great day.
Thanks, Berna. Thanks, Jen.
Berna.
Thanks, guys.